Now, the final version of the policy walkthrough. And you see here there are 50 pages, but most of those are optional reports that I included. So a real illustration will typically be shorter than this. And I'm not going to go through all the optional reports that I typically include, more for my own benefit, sometimes for the client's benefit. It just depends what scenarios we're illustrating. We've already been through this. This is the supplemental ledger. The only other thing that we would go through, and in fact, we would not even go through this. Notice it says current dividend scale. This assumes that dividends are paid at the current rate for this particular carrier. And it goes all the way out to age 121 if you lived that long, because age 121 is the maturity of the contract. The cash value and the death benefit must equal each other at maturity, which in the United States is age 121. It used to be age 100. So there were people who collected their death benefits tax free while they were still alive. So if you had one of those older contracts and you lived to be age 100, then they would pay you the full death benefit with no taxation. And in Canada, I believe it still is age 100. So you could, in theory, collect the full death benefit while you're still alive. I don't know if anyone lives to age 121, but in theory, if you were, that would be the maturity. But what typically happens is the policy matures when you meet your maker, and then that death benefit is paid out. There's just one other thing I'll mention here, this superscript. This term rider in this particular contract is being bought out. There are two different types of term riders. Term is temporary. In some cases, you might have a 30-year term rider on the policy where after 30 years, the term death benefit falls off. And in the illustration, you would see the death benefit drops by $1 million or whatever, how much was in term. Here, what's happening is the term is getting bought out. So the term is being slowly converted to permanent death benefit. And it tells you when that term death benefit becomes fully converted to permanent. And in this example, that is in year 16 of the contract when you're at age 51 in this example. That's what this little superscript is here. Notice the death benefit is staying level. It's increasing very slowly until you get to this point when that term is all bought out. And then the death benefit starts increasing much more quickly because all the term has been bought out and now we're just stacking on more permanent death benefit. But that's a little bit of inside baseball, perhaps not as important for the audience. The only other thing that's in here is the alternate dividend scale. So we can show some more conservative scenarios. We've showed the guaranteed rate assumes no dividend is ever paid. That has never happened. So that's incredibly conservative. It's probably guaranteed to never happen, but that would be the worst case scenario. And that, as I've said before, is the best selling point of whole life insurance, that there is a guaranteed rate of return. It's phenomenal. And I did a whole episode on why not only is the guaranteed rate of return the best possible feature of whole life insurance, if you were to get only the guaranteed rate of return, that would be the best possible outcome. And you can check out that video. I'll link to it. But here we assume the dividends go down, and we could assume they go down by a quarter point, a half a point, a full point, whatever we want to assume. And I'm not going to go through all this, but this is just showing you what those cash values would look like if the dividend were to be reduced. This is just a more conservative scenario. And I'm not going to go through all of that. By the way, one of the things that we are not allowed to illustrate is what happens if the dividend goes up. We are not allowed to illustrate that. And part of the reasons for the restrictions on all of this is that this eventually becomes a contract. So I want to emphasize that whole life insurance is a contract, and that is really important and super valuable. Contractual wealth. Contractual wealth is what's really important. With other financial vehicles, I want you to ask the financial institution that you're signing up with, what contractual rights do I have? Could you show me what contractually guaranteed rights I'm being given? What are you contractually guaranteeing me? That's an excellent question to ask. And if you ask that question, every other financial asset looks fairly poor compared to a whole life insurance. So again, whole life insurance is a contract. This is contractual wealth. You have contractually guaranteed rights. And it's pretty much a unilateral contract where the insurance company is signing up for all of the obligations, whereas the insured, the policy owner, does not have any obligations under the contract. The only contingency is that you keep the policy in force. And keeping the policy in force doesn't even require paying a premium. As we've seen before, you could take a reduced paid up. You could do other things where you could keep the policy in force with a reduced death benefit without paying a premium. And whole life insurance policies can be fully paid up. So you don't have to pay a premium forever. You could pay one premium and be done, or you could pay premiums for as long as you're alive, which is generally what I recommend. Once you understand how whole life insurance matures over time, you understand why those premium payments in the later years are more valuable and give you more leverage than the premium payments in the earlier years. But again, when you sign up with other financial institutions, the agreement is one-sided. You'll sign a lot of paperwork if you're signing up for a brokerage account, especially if you're signing up for a mortgage or any other financial vehicle. And all of that paperwork that you really don't understand and nobody explains to you is really about relieving the financial institution of liability if anything goes wrong. You don't really own anything and you don't really have any contractual rights. But whole life insurance is very unique in this regard, and you actually own something. We're not used to being allowed to own things. We're used to having to rent things from the government, from the technology companies, from the powers that be. We're given the illusion of owning something, like when we have money in a brokerage account or we have money in a bank account. In both of those cases, we're given the illusion that we own something, but actually we don't own anything. The bank, the broker, the custodian, they actually own the assets. And we just have kind of a liability to them with our name on it. Similar to if I make a loan to you, it's now your money and you have a liability to me, but it's no longer my money. But you actually own something. These contracts predate the IRS, they predate the Federal Reserve, they predate most of the modern financial system. And it's a throwback to a previous era where we were actually allowed to own things, where we had a more sound financial system. And some of these important contractual options that we walked through, some of these contractual provisions that we went through, such as your non forfeiture options. You have non forfeiture options where you can take a reduced paid up. You have other options if you want to either keep the policy in force without paying a premium, or if you want to avoid surrendering the contract, you have various means you can do. There's guaranteed growth. That's probably my favorite feature of the contract. The cash value is guaranteed to grow at a certain rate. You have guaranteed access to policy loans with no repayment terms. So you can borrow against your whole life insurance policy, guaranteed, no credit check, no bank involved, and there are no repayment terms because the death benefit will pay off that loan when you die if you never pay off that loan or pay any of it back. We went through premium and policy structure and why having a high base premium is important. So your premium generally is broken down into multiple components, but the only essential component is base premium. If we're doing infinite banking style policies, typically we have three components to that premium. There's the base premium, there's the term rider, and there's the paid up additions rider. Whole life insurance is a foundational asset. It's the foundation of your financial life. And the base premium is the foundation of the foundation. So that base premium is super important. So we want to err on making that base premium larger rather than smaller. That's very important. And we went through some of the risks of policies that are designed with lower base premiums and why I generally like to design contracts with higher base premiums, although I'm not against lower base premium contracts as long as the customers understand the trade-offs that they're making. I have no problem with them. I've certainly designed and put policies in force that have lower base premiums, but my clients understand the trade-offs they're making when they do that. We went through accelerated death benefit riders. So that death benefit can be accessed should you have some health issues. Should you be diagnosed with a terminal illness? Should you have some form of long-term care need? Some contracts, not the one we went through, will also allow you to access the death benefit if you have a critical illness, like a heart attack, stroke, or cancer. Whole life age is like a fine wine. This is something that I keep emphasizing. The most important element in whole life insurance is the passage of time. So the contract gets better every single year it's in force. Those premium payments get more efficient. That's why we should want to pay a premium for as long as possible because those premium payments get better every single year. They give you more leverage every single year. And ultimately, it's very simple. You're buying a permanent death benefit. That's really what you're buying, a permanent death benefit. And from that future guaranteed payment flow all the other benefits of whole life insurance. It all goes back to the permanent death benefit. That permanent death benefit, emphasis permanent, it's not temporary like term, that future guaranteed, very large tax free payout is the asset from which all the other benefits flow. And whole life insurance is completely unique. It is its own asset class. It's not just a unique asset, it's its own asset class. And this is why it's so difficult for us to understand it. Not because it's complicated. It's actually fairly simple, but it's just so unlike anything else in our financial life. And it really is a throwback to a more traditional form of wealth building that doesn't involve taking on risk, where the policy owner really actually owns something and has contractually guaranteed rights over it. So I hope this walkthrough of the contract was helpful. And I hope you started to understand some of the very unique provisions in whole life insurance. Perhaps it was a little bit technical, a little bit dry, but I think some of this is important and may be interesting. Let me know if this was helpful, if it was not helpful, if you learned something, if you didn't, if it was too dry, boring, and technical, or if you enjoy me going into the weeds. It may be helpful for other life insurance agents. I don't know if it's as helpful for potential clients who would like to do infinite banking or put a whole life insurance policy in force. But again, whole life insurance is a contract. And the more you read over this contract, the more amazed you are at how phenomenal this asset is. Thanks everyone for watching. We'll talk soon. Bye bye.